Klicken Sie im GoToWebinar-Bedienpanel auf die Schaltfläche Übertragung starten, damit alle Teilnehmer Sie hören können. Das Programm wird Sie benachrichtigen, sobald die Sprachübertragung beginnt. Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Welcome to our next webinar here at JFD Brokers. My name is Stefan Friedrichowski, as always. Sorry for the short delay, but there has been another webinar ongoing, and I have had to wait really until 7 p.m. Because I stopped automatically the other webinar, and therefore I have been straight at 7. It's nice to have you here back at JFD Brokers, and welcome in the name of JFD Brokers as well. Of course, I hope you will enjoy the topic of today. But before I really start, just that you know, as always, the webinar is recorded, and you will find the recordings from tomorrow onwards on the JFD YouTube channel. And if you are interested in later shown Excel sheets, and we will have a few of them during this webinar as well, you can send me an email and I will make sure that you get those Excel sheets if you want. And what you only need is my email address here. So it's s.friedrichowski@jfdbrokers.com, as you can see here on my first slide. I hope I will manage that during I speak here. I will upload already the PDF document so that you have the slides of today directly, and that you can download them here in the GoToWebinar control panel. Just a second, and they will be there. So we have an interesting topic, or maybe a totally different topic than all the other topics during the last year, more or less, because today it's about real stock trading simplified. So what is here? There are two things really new. The one is that today we deal with stocks. Up to now, we have been deep into forex trading, indices, gold, oil, so commodities as well, but never we have touched the topic of stocks. So, and the other new thing is that we will talk about stock trading not as CFDs, as contract for differences. We will talk about real stock trading, so real buying shares of a company, real assets. And that is something different as well. So both is new. Stocks in general and real stocks as well. So, but that is a topic, and that will be, at least for me, it's an enrichment for the overall trading activities, because we know how to deal stocks. Later you will know as well, or maybe you know already. But we can use some ideas of other trading strategies, and we can transform them to real stock trading, and we use a very big fundamental bias if it comes to stock trading, and we will talk about that as well. Okay, but nevertheless, I have always to show up with that slide here. Our risk disclaimer. Finally, we talk about trading strategies. But when it comes to your own trading, of course, you trade on your own responsibility with your own account and your own money. But I think that's self-explaining, and I have mentioned that already now. So let's structure a little bit today's webinar. So I want to touch a little bit more about why real stock trading is really an enrichment, and why it has so many positive aspects. And directly we come to the question, hey, how can I select the right stock value, the right company to buy the stocks? I will summarize a few of well-known criteria. It's only a short list, so we could even go further into that topic as well. But later you will see we can use a very easy approach. And then we don't have to look into the details of those companies, what is their business model and in which market they are, and so on and so forth. It's much more simple. But before really going into that kind of strategy, I have one slide. The one or the other may say, okay, that's a little bit simple stuff, but we will use the same logics, the same calculations within the later shown Excel sheet to calculate volume, stop loss, and something like that. Therefore, I want and I have to mention those kind of calculations here as well. But then it comes to the real strategy, and the strategy is a pullback trading strategy. And the name is already telling you how we trade. So we wait for a pullback. And that's more or less all. That's all what we do, because we can use the fundamental long bias of stock values in order to have the right direction, because we trade real stocks, so we will only go long because that's the only possibilities if you buy real assets, real stocks. And I will show it within two Excel sheets, because we start with one strategy and then we will extend that strategy a little bit further, because there are some aspect we want to get rid of, and therefore we have another variant, so that we only trade when it's really absolutely interesting. And I will do everything today for one example for Apple, but all the Excel sheets are already well prepared, so you can take any stock history of any company, put it into the Excel sheet, and then you can try around what kind of parameters you need for that specific stock value. Finally, and that's just for, let's say, information purposes, that you know, hey, it's not only working for Apple. I have already investigated a complete portfolio of stock companies, and what I did here, I looked for all the 30 companies within the Dow Jones and built a portfolio strategy for all of them. And I will share with you the equity of that kind of strategy, because that equity is already what I always call dynamic calculated. The one or the other may know what I mean with that kind of methodology. So it's a walk forward methodology, how in order to have not a strict back testing aspect, but later. So why is stock trading a real enrichment? So the first thing we have to keep in mind is that if we buy real stocks, and I mean real stocks, not CFDs on stocks, if you buy real stocks, you buy something with an intrinsic value. It's similar as if you buy a piece of gold. Because you have a share of that company. You are owner to a very minor percentage, but you are owner of that company. So there are real assets behind: buildings, knowledge, people, patents, whatever, products, product lines, and so on. So it's a real asset which you buy. So it has an intrinsic value. It's different than we open a long trade on euro, US dollar. Then we don't buy something with an intrinsic value. And that's a complete different story here when it comes to real stock trading. The other aspect is that you get dividends. Okay, only if that company is paying dividends, but a lot of companies are paying dividends, and so we can take that income, that return already as a small starting point. So why not? So it has already a positive aspect that we get dividends. The other good aspect is, compared to most of our other trading activities, is that we don't have financing costs. You know, if you open a long trade on euro, US dollar, we have to pay every night the so-called swap costs. Okay, there are a few pairs where you profit, where you have positive swap costs, but in general, for example, if you buy a CFD on a stock, then you have those financing costs. Or if you buy, if you open a long trade on indices, then you have those financing costs as well. So every night you have to pay a little bit. It's a small amount, but it's something you have to compensate as well. Okay, the disadvantage is that we don't have any leverage on the trade. So whatever we invest, that money is, let's say, gone. So at least it's within that stock value, but it's not anymore on my account. So that money is blocked and one-to-one because we don't have any leverage. So and finally, I put it in brackets here, but the one or the other might say, okay, that's an advantage as well. You can get a coffee in the annual meetings. So if you like, you can visit those meetings and you can participate. But okay, it's, I think, not the main reason to buy stocks, to have that free coffee. But now the strongest argument why to buy real stocks. Buying stocks is a long trading activity. So like going long on DAX or S&P 500. And we know that stocks on a long term go north. Okay, you may say, but not every company is going north over time. But there are a lot of companies really having that strong bias to the north. And there are two fundamental aspects. Those companies can only survive by growth, and even our complete economic system is based on growth. So that kind of bias we can use because a long trade is a good trade on stock values. And the other good story here is that now I think since 1 or 2 months, you can even buy real stock values directly at JFD brokers out of your MT5 terminal. So that's a really good story. So you can use the normal environment like MT4 and then directly buy real stock values, not CFDs. That's possible even for a much longer time. But now you can even buy real stock values. And the costs, the transaction costs, is $2 per round turn, which is really a fair price for such a round turn. So it's quite interesting. But now, yeah, okay, we have to select what company, what do we want to buy. And then I call it now the normal story behind is something like in my list. I go through that list, but it's really just a summary of maybe something you have in mind as well. So if it comes to stock trading, you may say, okay, I like that specific company. I know them very well, and maybe you even work for that company. I know the business behind. I know what we can expect. That's a company I invest money in. So I buy stocks of that company. And honestly, a long time ago, I have worked closely with a company which is called ASML. That's a Dutch company in the semiconductor environment, building production equipment in order to manufacture chips, computer chips. And yeah, I knew that company very well, and I invest money in that company, buying stocks. And it was really a good story for me and for the company. So you may trade what you really know. Or the other idea might be to say, okay, I only buy strong values. You may have some logic to distinguish between strong and weak values, and maybe it's just to you compare to an EMA and say, okay, all the ones which are above the EMA I go in, or you even select on a monthly base which one has the strongest growth, the strongest return, and then you go for that company. So that would be buying the strong values. Or another selection criteria might be, okay, I only buy companies, stock values for those companies which really pay dividends, because I want to have that part in my pockets as well. So another idea. Or you do real hard work. diving into their business models, into you have a list of interesting companies, and you really go into their business models. You have your own opinion about what they are doing. You have your own opinion about their potentials. You have maybe other sources telling you something about the potentials. Like a story, okay, right now artificial intelligence is a buzzword. You go in companies which doing exactly something like that. So that might be a selection criteria as well. Or finally, you do fundamental analysis. Oh, it's fundamental analysis written on my slide, but it's fundamental analysis, meaning you look into the balance sheets, you look into the profit and loss statements, and then you get your own opinion of what that company might go for and how it will go in future. All that you can do, and I would not tell, hey, don't do that, but we can do it much more simple. So it will be really simplified. We don't have to do that kind of stuff. We can do it more or less as a systematic trading approach. But before doing the pullback strategy, just a few words on how to calculate trades when you when you buy real stock values. So, okay, I know, and you may know already how to calculate everything, but at least then let's go quickly how to do it and repeat that kind of stuff here as well. So, an example, I want to buy for $1,000 Apple shares. Okay. The actual price, and by the way, that was the price yesterday morning, is 192.3. And so the question is, how many stocks can I buy? Okay, that's quite straightforward. It's 1,000 divided by 192, and I get 5.2. And since you can not buy any parts of shares, it has to be an integer number. So I round that number down to 5. So I could buy 5 shares. One story. But now we are trader, and as a trader, we know we can place stop losses as well. So if I want to buy Apple stocks and I have in mind, okay, I want to place my stop loss as 160, and I'm willing to risk in total 500 euro. So that means when the price would go down from 192 to $160, then I want to risk $500. So that is the overall risk I'm willing to accept. Then I can buy a little bit more shares. The calculation is straightforward, 500 divided by 192 minus 160, and I can buy 15 shares. Well, so that's nice. I can even buy more, and I'm still willing to risk $500. But the downside is still my investment sum. So the money I block with that Apple stocks is close to $3,000 because I have to buy 15 shares. So the invested money is close to 3,000. My risk is $500 if I place my stop loss at 160. So that's the kind of calculation you do here. It's straightforward. Sorry, just I mute you. So I'm back again here. One remark on that kind of calculation. Because the stop loss is only active during trading hours, and let's keep it simple, between 3:30 German time and 10 p.m., that stop loss is active. That means overnight, I don't have a real stop loss. So assuming the close price the one day might be 162, so close above my stop loss, and the open of the next day is 155, then I will lose per share $5 extra. So I have that risk of overnight gap. That's the name for that. it's not quite probable that the share will wake up in the morning with 30. So I can think one can handle that risk, but I want to mention that additional risk, which is indeed there. So we have that overnight gap risk, which go down below our stop loss, and nothing can protect me for that. But that's a kind of calculation. But now, how can we do that pullback strategy? And the approach is really quite simple. Let me guide you through the chart, and I will explain it specifically for one point in history here within the chart. So I go back to the 27th of March, and that is marked with the dotted blue line, the vertical one, and the open of that candle is marked with a blue line here, and the open on that day has been 173.92. So that was the open at that specific day. Based on that open at that day, we place the buy limit order. A few, in my case here, 2% below the open. If you do the math behind, you end up with about 170.55 to be exact, and that's a green line. So at the open of the market at 3:30 German time, we do that placement of that order. You may ask, hey, why 2%? Let's see. We do a back testing with that kind of strategy later within that Excel sheet, and then we can even try out what buy limit order limit, also the percentage value, is most suitable, and it will be close to that number, by the way. But we can do that kind of back test. So my example trade here later, we will do the same logic for the complete history of complete means in this case I started with the year 2000, so with 18 years history. So what back to that day. At that day we place the buy limit order, and of course we can see the red candle here. During the day that order is filled, meaning the price passed our buy limit, so the buy order is automatically filled, and we have now shares. In my case, 5 shares. Why 5? Okay, 5 because I want to risk $50. So going back to our previous calculation, that means if my entry is at 170 and I want to risk $50, I can buy 5 shares if I place my stop loss at 160. So that's a complete logic. So now we have our 5 shares. We have a stop loss at 160. And now it goes further. We wait. In the first kind of strategy, we will immediately go already to the next step, but we could wait until the end of the trade. In this case, I place a take profit level, a target, and my target here is $100. That translates, if I buy 5 shares, then that translates to a target of 190. So there's a take profit. I get a question here of once again to the kind of calculation. So the starting value here is when I want to place my order, I have to answer the question how much money I would like to invest into Apple. And in my case, I set that number fixed to $1,000. So whenever I open a trade, I want to invest $1,000. And those $1,000 directly translate to 5 shares. It's the same calculation on the previous slide. Now the next step is I want to risk $50. And the logic is now the stop loss here is calculated. It's not taken out of the chart. It's not like making chart analysis. No, it's purely calculated. Since I have 5 shares and I want to risk €50, then per share I can lose $10, and that means my stop loss has to be $10 below my entry. That's the logic for calculation. Same with the target. I want, if the trade will be a winner trade, I want to profit with $100. That means I have to gain $20 per share. And that means my take profit is at 190. So that's all. In my case, of course, whenever you build a strategy or you want to illustrate that kind of strategy, you do it with a trade which is running well. So later here, the trade comes to take profit. So, and we would not do in this first step nothing else after the first trade. So whenever we place the order, and if the order is placed, we wait until that trade comes to stop loss or take profit. But we can do it better. And the idea is, okay, let's do it iteratively. So going to the next day. So at the next day, we are already invested, and at that day we would be in the minus because price went even further south. We place once again such a buy limit order. Once again, 2% below the open of that day, so the open of that candle, which would be about here, so where the mouse cursor is right now. Okay, that order would have not been filled. Anyhow, we do it the next day, and all those days you can do it visually here, going for the distance between those two lines. It's not absolutely correct to move that distance to the south, because then we would not do it percentage-wise. But anyhow, it would more or less look like that. You would see none of those orders would have been triggered. Later, the first one would be here. Exactly here, we would open the next trade, because here the open is at that level. It's by purpose the green line here, and now we would place the next buy limit order about here, and that would have been filled. But now we would recalculate stop loss and take profit, still under the assumption that we want to risk finally $50. It will later turn out that that number is a little bit too small, and that we want to finally profit $100. So since we do a second buy, our stop loss will come closer to us. But the good thing is the take profit will come closer to us as well, to our current price. So that's the idea. We do rebuys, but normally people are telling doing rebuys in a loss is a nightmare. Yes, but only if you don't have any limits. If we have a fixed number of dollar or euro we are willing to lose by that trade, and we will not increase that number, then that kind of logic makes sense. But only then. So we don't want to risk more. It will be, in that case here, still $50 for then both trades, the overall trade sequence. And that makes it quite interesting. So let me repeat how that process is done, and then we jump into the Excel sheet and see how the backtesting works for that kind of strategy. So the first alternative has been, whenever the first trade starts, we do nothing until that trade reaches stop loss or take profit. Or, second idea, we do it every day. there will be a lot of days where the buy limit order would not be filled. But anyhow, we do it every day. But since we use a fixed amount of risk money, we have to adjust our stop loss for the overall summed up position. Same for the trade profit. So finally, if that trade sequence will go for stop loss, we will lose that fixed amount of money. Same for the take profit. So we think in trade sequences and not in single trades. In the Excel sheet, we do it a little bit different, but that is only because otherwise we get a problem with stop loss and take profit, because we are using daily candles, so daily prices for open, high, low, close. We have a problem that we don't know exactly what event is first. So we don't know whether the high is before the low or the low is before the high. So finally, I cannot look into the day. That I could only do by going for smaller time frames of my price history, but then the Excel sheet will be a little bit more complicated, or simply will be longer. So we do the following, and for stock trading, that is something which is okay. During the day, the buy limit order does not have stop loss, neither take profit. If that order is filled, okay, it runs. If we have already ongoing trades from previous days, they have a stop loss and a take profit, exactly how we did the calculation before. Maybe that part of our trade sequence is running in stop loss or take profit. Okay, that we can calculate. For the new filled buy limit order, we do the stop loss and take profit calculation on the next day. That's how we do it within the Excel sheet. And let's look how that works. And then we come to an improvement of that kind of strategy. And here is our start behavior within the Excel sheet. So let me guide you a little bit through that Excel sheet. You can have it. I send it whenever you like it. But that you know a little bit about how the logic is working here. So of course we have the historical price data, in this case for Apple, and then it's straightforward. We have such a buy level. And you find that 2%, and you can change that number. I marked it already in yellow, that we might change that number for buy levels. And we use the same buy level for the complete history of 18 years. Then we get those days marked which achieve, which reach that buy level. And then it comes to the calculation of the size, so the volume, the number of shares we are buying. Those are based on that invest money, and that is 1,000. This number you might change, but just for optimization purposes, just leave it as it is. So let's go for, oops, that was wrong. I want to have this here and this one not filled. Okay, so that is only for calculating the number of shares we buy. The real numbers which are very important is my stop loss, my risk value for a trade sequence, and my take profit level I want to have in dollar, in this case in dollar, because Apple is priced in dollar, and those I would change. If you dive a little bit deeper here into the Excel sheet, what really counts is a ratio between the size value, stop loss value, and take profit value. Therefore, you don't have to change all the three of them. And the rest is done here by the Excel sheet itself. So whenever we buy here, for example, in the second row here, we reach our buy level. And of course, as I mentioned, during that day of buying, we don't have a stop loss, we don't have a take profit. With the open of the next day, we place a stop loss and a take profit, and then it goes further. If we do additional buys, you will see here, let me move it a little bit down, that on that day here, we get a second buy. And therefore, we have an increased size of that trade. And everything is done here iteratively until we reach stop loss or take profit. And now let's look a little bit to the three graphs here, so that you know what is we presented there. And at the lower end, quite easy, that's the price of Apple during the last 18 years, just for illustration. And then the maybe most interesting part is the equity. That is the calculated equity based on that strategy, including commissions, so transaction costs. And yeah, that's the one we would get if we trade Apple with that pullback strategy, with the buy level of 2% and invest some per trade of $1,000, with a stop loss of $200 and a take profit level at $1,000. That would be our equity. And just for information, I have plotted two additional things here in that final thread graph, and that's the amount of invested money during those 18 years, and finally in red, the floating loss or profit of our trade sequence. And now the good thing is we might change those numbers and see, okay, this is one equity profit in total close to 15,000 euros, and you can see some specific slope. And what I did here, I calculated one key figure in order to help me in order to see whether when I change the parameters, whether the strategy improves or not. And the key parameter here is simply the slope of the equity divided by the average amount of money invested, because both matters. Okay, we want to have a huge slope, high values of for the slope, and we don't want to invest that much of money. So therefore, we have that ratio of slope divided by average invested money. And now we can change parameters. Like, for example, we can go up with a stop loss value from $200 to $300. And we can always see how the equity changes. Okay, gets a little bit better. Oh, no, let's not go for 40. Let's go for 400. But 40 is not that bad as well. So surprisingly, what happens now? We have such a small stop loss. We get a lot of trades, and the overall equity is doing quite well. But let's see what happens if we go higher the road to 400, for example, for the stop loss value. And we will see, okay, slope divided by average invested money is lower, but I like the kind of equity here, and maybe we should go for other numbers like 500, and then we will change other values here as well. And let me, okay, wow, this doesn't look that bad, 500 and 2% buy limit, so we are close to what we want. And the equity is improving by changing those numbers. And now I increased the buy level a little bit more. That means we don't have that many trades. And if I now go up even to $900 for stop loss value, then it improves once again, but only slightly. But anyhow, so now that equity doesn't look that bad. And you can see how easy you can find out those parameters. You can do it for other stock values as well. And you may ask yourself, wouldn't it be better to have one parameter set for all the stock companies? Let me re-question that. Why? Why should every company and the historical price and the future price changes behave the same. There are companies which are much more stable. And there are companies which have strong up and downs. For example, General Electric is more slow. Apple is one of those companies with huge highs and lows. So if those price changes are that dramatically different, so why to trade every company, every stock value with the same set of parameters? There's no story behind that. Therefore, we use individual parameters for each stock value. And just that you know, if you go for Microsoft Excel, then you can do that kind of optimization even automatically. So you click on those numbers which you like to change, and then you use within Excel the so-called solver, and that is finding a maximum by varying some certain cells, and then you can leave that job, that kind of optimization, to the computer, and it will do the job for you. So it's quite easy to optimize such a strategy here, more or less automatically, which is really a fine thing. But now let's look a little bit to the Apple price chart here. What we are doing here is long only. That means we want to be part of going north because it's a long strategy. And I don't have a chart by hand here. Think about the chart of Deutsche Bank in Germany. That chart is going south, I think, since nearly 1 decade now, since financial crisis. So, okay, if a company, the price of a company is going down and down and down and down, maybe we should not trade that company. But that we can do quite easily. Let's use an EMA simply as a filter. Let me illustrate that within a chart. So we have here, once again, the Apple chart. It's more or less the same picture than before. And I put one EMA within the chart. Right now, it's an EMA with a period of 40. And I would add just a simple logic to our entries. Trade only. We place only buy limit orders if the price of the open is above that EMA. So that helps us to say only if the overall price is going north. So if we have a more long-term behavior going north, yeah, okay, then we do that kind of buy limit orders, that kind of pullback strategies. And in those cases, like here, when it's below the EMA, we don't trade at all. So we stop trading and look for other. The universe is bigger than one stock company, so we can go for others as well. So we have a logic which would say, okay, Deutsche Bank, we would not trade with that kind of strategy. It might work, but why not going only for those which are stronger? And then use a pullback strategy in order to get the better entry price. So that's straightforward to have that kind of EMA as a filter. And let's use that here as well. But I have to make one additional comment for that. So, okay, we use that EMA as trend filter, and we only place trades if the open is above the EMA. But there's an exception. Think about, we have an ongoing trade already. So we are invested in Apple. And then the price crosses the EMA to the south. So the next day we are still invested in case the stop loss is not reached. In that case, I would open once again a buy limit order. because we get, if the sequence goes a little bit further, we get in average a better entry, and we have still the possibility to recover that trade. But we would only do that process of rebuy, even in case we are below the EMA, until that trade sequence comes to an end. If that trade sequence comes to an end, then we stop trading for that stock value. So the overall advantages in weak market phases, we do not trade. And the same which is mentioned here on that slide is now next in the Excel sheet. And now we have an additional column here, EMA, and we have one additional parameter, which is the EMA period, which we might change. And now we have we have 4 parameters we can turn, and then we can see how that behaves. And of course, I can change here those parameters. Always we get new equity lines, and you see already, okay, that improves. It's getting better and better. And I want to share with you one really weird solution, just that you see what's possible here as well. Let me go for buy level of 2, and I go for a quite strange stop loss value. Let me go for a little bit bigger money, 20,000, and going down with a take profit to 600. Wow, what's a nice equity. So it's really looking quite well. And what it's behind. In this case, there has been one moment, and that was during the financial crisis. We have had a trade finally ending up with an invested money of 50,000. And we need that stop loss level here of 20,000 in order to survive the trade, specifically at financial crisis. But on the other hand, the equity looks really well. So you see, we can, with that additional filter, but with not that weird parameters, we can get fine values as well. Let me change the EMA period a little bit to other values and don't have a stop loss value of 20,000. Let's go back to 900 and go back for the take profit of 1,000. Then we still have quite well equity, so it works well. And that we can do for all stock companies, all your pre-selected list of interesting companies, and you find a good set of parameters how to trade that company. And that concept is really working. I have investigated with that, and I hope you know a little bit when I say with that walk forward methodology. Let me explain briefly what that means. So what you do is you go in the history of your price chart, and then you say, okay, let me investigate 2005 until 2010, and then you find the good parameters or the best parameters for EMA, stop loss value, buy limit, and take profit, and you optimize for those 5 years. Good, job done. But now you apply those parameters in the future. So you have done the optimization between 2005 and 2010, and you apply those parameters in 2011. So in the future, from the perspective of the optimization. The 2011 has not been part of the optimization process, and you look for the results within 2011. Okay, you record them, you write them down, and you put them in an Excel sheet or wherever, and then you do the optimization once again, but now from 2006 to 2011. You do that optimization, and you apply the best parameter, your best found parameters in 2012. So you always do optimization and apply in future. That means your parameters have not been part of the optimization. And that's exactly what we would do from tomorrow onwards when we go live with that kind of strategy. We have an optimization window, and then we go for trades from tomorrow onwards. So that's exactly what we would do in future as well. But still, I can record all those trades of always in future. And I want to share with that result with you here as well. And that looks like this. So that is a portfolio of all 30 Dow Jones companies. Honestly, I selected those 30 companies which are today in the Dow Jones. I know from time to time there are changes, and I have not looked into that kind of changes. I did the calculation for all the companies which are today within the Dow Jones, and we have a really nice equity. So we gained nearly $2,000 here with a really smart drawdown. Drawdown within that strategy is only in the range of $10,000. So earning 200,000 with a drawdown of 10,000, that is quite a well strategy, and that is already the result of that walk forward. So all the trades recorded and shown within that equity are those future trades added up once again. And if we have such a result, still, it's, let's say, a proof for the logic of that strategy, and that you can do that kind of optimization and then trade it from tomorrow onwards. So it's really looking nice, and I hope I can find a way that we have that within our overall portfolio as well. But let's see, because it would be another step of diversification, and still this is without dividends and stuff like that. That is not taken into account. That would come on top of what we have here. That's about pullback strategy for real stock trading. Let me summarize. So real stock trading is quite attractive, and we have still to keep in mind that we are buying real assets and with an intrinsic value. And we know that even going for a quite simple strategy like this one here, the pullback strategy, shows really well results. And the other good thing is that we can buy it directly out of MT4 within for JFD. Not MT4, sorry, that was a mistake. It's MT5, but behaves for that kind of trading more or less the same. So it's not a big deal to come from MT4 to MT5. And you can do everything still in your well-known platform. So, and with very good cost level of $2 per round turn. So that's a pullback strategy. I hope you enjoyed, and I hope, I will see you later in 2 weeks. We will have the next webinar. Time to Trade, I think, is the name. That is more an intraday strategy, not something like this one here, where you have really you have only one action, that is at the open of the market. So at 3:30, you would have to do something, because the automatically canceling you can do automatically, that the order cancels if not filled by expire functionality within MT5 or MT4. And so here you only have one action per day, but in 2 weeks we will have more action, so to say, and I hope you will enjoy as well. If you want to have those Excel sheets, no problem, just send me an email to s.friedrichowski@jftbrokers.com, and I will make sure that you will get those Excel sheets in LibreOffice and in Microsoft Excel. Okay, that's for today. All of you, a good evening, and see you hopefully in 2 weeks again. Bye-bye.